Hey everybody, Justin Walsh here, branch manager at Franklin Loan Center in Ladera Ranch. Hope you're having a great day. Today's video is on the difference between putting 15 and 20% down on the purchase of a home. In the years I've been doing this, there are tons of potential homeowners that are under the impression they have to put 20% down to get the best possible loan terms. And the good news, and what I'm going to showcase in this video, that's just simply not the case. There are great loan terms available for 15%, shoot, even 10% down. But in this particular example, I'm going to show the difference between putting 15 and 20% down on a home loan. So the purchase price in this scenario is $750,000. And on the left-hand side, we have a 15% down scenario. And on the right-hand side, we have 20% down. So the first thing that most folks think of when putting less than 20% down is they're going to have a really expensive PMI or private mortgage insurance that they pay on their payment. And PMI is required on 15% down. However, PMI is insurance for the lender that protects against default. So when putting less than 20% down, that PMI is basically there to cover the lender's butt in the event that that homeowner doesn't make their payments. Well, as a result of that, that's an extra layer of insurance or less risk for the mortgage bank. So what you see and what most or hardly any homeowners realize is you actually get some closing cost credits with 15% down that you do not receive with 20% down. So let's look at this example. So on 15% down with cost and escrow and all that stuff that is included, this homeowner is putting down $118,000 at 15% down versus 20%, they'd be putting $157,000 and change, okay? The payment difference in 15% down, we have a payment of $33.78, 20% down, a payment of $31.29, I'm sorry. So on the 20% down option, that homeowner is saving an additional $248 a month by putting about $39,000 more towards their loan at closing, okay? So $39,000 more saves them $248 a month. The interesting thing here, on a scenario with good credit, the private mortgage insurance is only $53 per month. It is not a substantial amount. And that private mortgage insurance is temporary. On 15% down in this scenario, this is going to be part of the payment for 43 payments. Okay, so 43 times 53, roughly $2,400 per month. Once that 43rd payment's been made, that PMI would fall off of that payment. So it would be gone at that time. But going back to my point here, the 15% down loan option is actually $1,500 cheaper with the same credit score, same everything. You save $1,500 on your upfront cost when you put 15% down. Going back to a point I made earlier, the mortgage bank has insurance against default with this 15% down. So they have another layer to avoid risk at their disposal with this 15% down option. And loans are priced out based on risk or less risk. So this homeowner is paying $1,500 less in closing cost on the option with PMI versus the option without PMI. This nearly pays for those 43 months of PMI. So this is a scenario that's really, really important because what we see on most home purchases, homeowners on average spend about $20,000 to $30,000 on their home in just the first year when they buy the house. So the last thing you want to do as a homeowner is put all of your money towards a down payment and then get into credit card debt or revolving debt by furnishing, upgrading, or adding things to your new home purchase. You will save so much more money by not utilizing credit cards, by putting a little bit less money down and then saving those funds for the things that you're going to want to invest into the house. And I think this is a really impactful topic. If you have more questions on this, you can call us in the number that's in this video, or even on the top right of this video, there's a link where you can answer a few questions, and we will pull this up specific to your scenario. But for conventional loans, 15% down is a very, very viable option to keep money set aside, not go into credit card debt, and not overextend in terms of the amount of liquid money that you're putting towards the house. Hope this was helpful, and talk to you soon. Thanks. Bye.